are we once again staring down the barrel of a recession? Today's video shines a light on foreboding economic signals.
Absolutely. We're talking about everything from rising unemployment rates to alarming trends in the transportation sector. Today, we'll summarize the latest from leading financial experts on how these developments affect your investments.
Welcome to another edition of Financial Insights in Minutes, where we deliver the most critical financial news without the hassle. In today's video, we'll cover some urgent topics you need to know about the economy and stock market.
Let's dive into highlights from the following videos.
Let's dive right in. Today, we're navigating turbulent economic waters. The question at hand, are those economic winds signaling a recession?
Here's the full report. We're witnessing troubling patterns in the transportation sector alongside rising unemployment rates. It's reminiscent of previous downturns, suggesting a bumpy ride ahead.
So, what's the core thesis we're unpacking today?
The video warns that the current trends in transportation stock performance mirror past indicators of recession. Rising unemployment rates could mean we're following a dangerous economic pattern.
Let's break down the first point. The transportation sector. What's happening here?
The transportation sector is plummeting, similar to 1999 before the recession. This trend typically indicates troubling economic signals.
And what about consumer stocks? Are they feeling the pinch?
Oh, absolutely. Consumer stocks have noticeably weakened. If consumers aren't spending, that slows down the entire economy, heightening recession risks.
Now here's a twist. The banking sector is showing resilience. What gives?
That's a good sign. Historically, when banks do well, it's a positive indicator. It parallels behaviors before previous recessions when banks collapsed.
Let's look ahead. What do the forecasts say?
We may see rising unemployment as a sign of deeper economic troubles ahead, just like we've experienced in previous downturns. It's the beginning of a worrying trend.
And how might consumer spending react?
Consumer spending will likely drop if confidence continues to erode, leading us closer to recession territory. It's a classic sign of an economic slowdown.
So what are the big takeaways as we wrap up?
We're seeing unmistakable signs of a recession, but some sectors are still resilient. Monitoring these trends will be key as we move forward. So when should we really start worrying?
What do you think? Are we heading for a recession, and when will it hit?
Let's continue this conversation in the comments. Your thoughts could be the next big indicator we talk about.
Today, we're diving deep into the economic currents with Professor Steve Hanke, a renowned expert from Johns Hopkins University. Get ready as we navigate through the latest monetary policies, recession predictions, and some spicy insights on big tech.
Absolutely. Hanke is here to unpack the implications of the Federal Reserve's latest moves and their ripple effects on the global economy. With his expertise, we're sure to uncover some valuable insights.
What crucial insights should we take from Professor Hanke's analysis?
The core thesis reveals that anticipated Fed rate cuts might drive the dollar down, which, while expected, raises concerns about underlying economic vulnerabilities that could lead to a recession.
So, what are the key points surrounding these Fed rate cuts?
Hanke highlights that a rate cut is on the horizon, with market sentiment split on the extent, predicting it may shake up the strength of the dollar across the board.
Let's discuss the job market. What does Hanke say about it?
He's pointing out that major job count revisions, reflecting a drop of approximately 800,000, signal troubling times ahead, reinforcing the idea of a recession as contraction rates climb.
Now let's dive into inflation. What's the forecast?
As per Hanke, inflation could stabilize between 2.5 to 3%, closely mirroring current trends. His accuracy in previous predictions adds weight to this claim.
Looking into the crystal ball, what predictions does Hanke make?
He foresees a downturn with the economic contraction from the Fed's actions, suggesting the U.S. might slip into recession territory by the year's end.
And what about the impact of political policies?
Hanke warns that government actions could pressure monetary policy and lead to complex challenges for tech companies amidst an evolving regulatory landscape.
To wrap up, what should we take away from Hanke's insights?
He emphasizes the importance of proactive measures to prepare for potential recession impacts, while urging careful consideration of evolving tech regulations and their economic implications.
Today, we're diving into the pre-market prep breakdown of the PCE inflation data and its market reactions.
Absolutely. As we gear up for this insightful analysis, PCE data will be our focal point.
So what's the primary takeaway from today's market reactions?
The PCE inflation data is crucial. It's the Fed's preferred inflation gauge, providing insights into potential economic shifts.
What can we expect from the PCE report?
While the market anticipates stability, the specifics of the data, especially service inflation, could still sway trading decisions.
And how is the market responding post-PCE release?
Market reactions have been tepid so far, reflecting a wait-and-see attitude among investors.
Speaking of earnings, how do they affect the market today?
Dell's strong results provide some optimism, while Lululemon's disappointment creates caution among traders.
What are the forecasts from the market's pulse following PCE?
There's a chance for increased stability if PCE numbers align with expectations, but volatility remains on the table.
And speaking of timing, how will the long weekend influence trades?
Many traders might play it safe ahead of the holiday, potentially leading to reduced volatility.
To wrap up this segment, why is the PCE report so pivotal?
It sets the stage for Fed policy decisions and directly impacts market sentiment moving forward.
As we close, how will you approach inflation trends in your trading?
Share your insights in the comments. What's your strategy moving forward with inflation in focus?
Time to navigate the currents of today's discussion. With September regarded as the worst month for stocks, what can we expect this year? Amidst a U.S. election, a Federal Reserve rate cut, and Nvidia's post-earnings sell-off, the market is in for quite a ride.
Let's get straight to the facts. The video reveals data that could influence market movements, questioning whether we're in for gap fills, bounces, or if we're heading back to those recent lows.
The crux of the discussion revolves around the historical perception of September as the market's worst month. Will market behavior deviate in 2024 due to the context surrounding elections and monetary policy?
Indeed, the upcoming Federal Reserve rate cut adds a pivotal twist. Speculation is rife about the potential for the market to either strengthen or plunge. Which one will prevail?
Diving into September's historical trends, what's the scoop on sell-offs?
September usually spells trouble with notable sell-offs. However, recent forecasts hint at a more mixed performance, leaving investors anxious yet hopeful.
Speaking of rate cuts, how does that influence market rallies?
Rate cuts are often a precursor to market rallies. However, there's a looming concern about timing and already anticipated recession. Will history repeat itself?
Now, let's shift gears to Nvidia. How does its performance affect the wider market?
Despite its influence, Nvidia doesn't dictate market trends alone. Its recent earnings might stir sentiment, but the broader reality remains more complex than just one stock.
Looking ahead, what are the predictions for the market post-rate cut?
There are two scenarios, one where optimism leads to upward momentum, and the other which shows signs of sell-offs indicating an impending recession. The stakes are incredibly high.
What should investors anticipate in terms of asset strategies?
Investors may need to pivot towards defensive strategies as market dynamics shift. Late cycle trends could favor sectors like utilities or gold. It's a potential survival tactic.
As we wrap up, what are the key takeaways for investors entering September?
Seasoned investors should brace for volatility. September carries risks and the potential for sharp movements. Keeping an eye on Fed signals and pivoting strategies accordingly could be the way to navigate this storm.
What do you think will happen following the rate cuts? We want to hear your predictions.
Engage with us in the comments below. What are your bets on the direction of the market?
Setting sail into today's discussion about the U.S. economy. With GDP nudging upwards, how sustainable is this growth amidst rising debt?
Right, and the numbers tell a different story when we delve deeper. Antoni, with his extensive background in public finance, will help us cut through the noise. Let's get straight to the facts.
So what's the crux of the matter? Is GDP growth truly reflective of economic health?
In essence, it's a mirage. Much of this growth stems from unsustainable government spending and an alarming debt rise. Over $35 trillion. Are we borrowing from our future?
What's the scoop on consumer debt?
Record levels, over $17 trillion. And astonishingly, Americans are shelling out $300 billion just for interest payments. That's a major red flag.
Now let's talk about inflation. How's it affecting wages?
Real wages have plummeted by over $4,000 since 2021. It seems inflation is taking a huge bite out of the middle class's purchasing power.
What's the latest on employment? Are those job numbers trustworthy?
Not really. The job revisions slashed over 800,000 jobs. There's mounting skepticism about the data coming from the Bureau of Labor Statistics.
With all these challenges, what does EJ predict for the economy?
He warns of potential economic stagnation if we don't address the debt issue. If credit tightens further, those consumer finances could be in real trouble.
And what about policy predictions? Are we expecting changes before the elections?
Definitely. The upcoming elections could influence significant policy changes, with debates on reducing spending and regulatory burdens heating up.
So what's our conclusion? How do we navigate this middle-class squeeze?
Ultimately, a dual focus on minimizing debt impacts while promoting real wage growth is crucial. The coming months will be telling on how policymakers will tackle these deep-rooted issues.
What's to keep an eye on moving forward?
Watch how the government addresses spending and regulations. The future of the middle class hangs in a delicate balance.
Before we wrap up, we want to hear from you. What strategies do you think can best support the middle class as we move forward?
Drop your thoughts in the comments. It's important to keep this conversation alive as we navigate these economic waters.
As we wrap up our discussion, each expert presented compelling arguments regarding the economic climate and potential recession signs.
Game of Trades noted the troubling indicators in transportation stocks, raising questions about consumer spending.
Steve Hanke highlighted the effects of possible Fed rate cuts, suggesting they could weaken the dollar and complicate economic recovery.
Antoni framed GDP growth as deceptive, pointing to unsustainable government spending overshadowing individual debt growth, therefore urging a focus on financial discipline.
Thank you for joining us. Follow for more timely updates in the dynamic world of Remember to like and thanks for watching Financial Insights in Minutes for August 30th, 2024. If you found this time-saving content useful and want to support the channel, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.